Ratio Magic. This is reading from Managing by the Numbers by Chuck Kremer and Ron Rizzuto with John Case. This is Chapter 11, Ratio Magic. Analyzing Performance with the DuPont Equation. The central theme of this book is that financial statements fit together like a jigsaw puzzle. Changes on one statement are reflected on another, and if you put them all together into the financial scoreboard, you can trace cause and effect. You can see why your business's financials turned out the way they did. That's important because your real job isn't just to understand the financials, it's to run the business and to use financial information to help you run the business better. What we have provided so far might be called the basic analysis of financial performance. The next step is what we call power analysis. Power analysis shows you how the ratios themselves fit together. It shows you how you can use the connections among them to analyze your company's performance still further. The connections are captured in just one equation, an equation that includes many of the key ratios that a business owner or manager must pay attention to. It was first developed at E.I. DuPont de Nemours and is known as the DuPont equation. The simple DuPont equation. The DuPont equation begins with an insight about return on assets, ROA. So ROA is return on assets, the ratio we discussed in the previous chapter. ROA, return on assets, can be broken down into two component parts. Doing so allows you to ratchet up the magnification, so to speak, and gain more insight into exactly where any ROA problems might lie. Okay. If ROA is a number that many companies use to analyze their financial, the first component, it's supposed to be of, I think it's a misprint in the book. The first component of ROA is a number that many companies use to analyze their financial performance. Return on sales, or ROS. The measure also goes by... Sorry. My foot was cramping and I had to move my foot, so it knocked over the thing. Okay. The measure also goes by profit margin, net margin, operating leverage, and other names. So that's ROS, which is return on sales. So the ROA, again, is return on assets, and ROS is return on sales. So return on sales equals net profit over sales. Return on sales equal net profit over sales. Get out your company's numbers and check them. Is your return on sale positive and growing? Just as with many other ratios, we can't tell you what a healthy ROS, return on sales, is without knowing your industry. Supermarkets are lucky to make it to 2 ROS. Microsoft made it to 39% ROS in the fiscal year ending June 30th, 1999. But you can always gauge your company's ROS against industry averages and against your own performance in the past. What if your ROS is headed in the wrong direction, or if it's weak compared to your industry? First, look at sales as a pure dollar figure. Are your sales increasing? Are they going up at a rate faster than inflation? If sales are flat or declining, that's likely to be a problem in and of itself, particularly if you're trying to grow the business, and therefore you're using money on costs and expenses. If you are using money in hopes of growth, but your sales are not increasing, you may be in a cyclical trough, or you may be in the wrong business. If sales are growing, but the ROS is poor, you have a profit problem. It may be that your gross margin is decreasing, or that your expenses are increasing faster than sales. You can analyze this problem using ratios in Chapter 8. The second component of ROA can be figured out with a little 9th grade algebra. Here's how we do it. We know that ROS equals net profit over sales. ROS equals net profit over sales. We also know that ROA which is return on assets, right? Yep. Equals net profit over assets, right over here. ROA equals net profits over assets. So we can write a new equation for defining return on assets for the following. Return on assets equals net profits over assets, which equals sales over assets, times net profit over sales. So it looks like this right here. Looks like that. Or this equation down here. Okay. The new term, sales divided by assets, is known as asset turnover. So sales divided by assets is called asset turnover. It measures how many times in a given period your assets turn over in the form of sales. Remember, assets always refers to an average assets during that time period. Sometimes asset turnover is also referred to as marketing leverage because it shows how much marketing bang you're getting for your asset buck. The ratio measures how customers are reacting to the resources you have invested on their behalf. If a modest amount of asset generates a lot of sales, they are reacting favorably. If a lot of assets generate only a moderate amount of sales, customers are voting with their feet in the opposite direction. Other things being equal, higher asset turnover translates into higher return on assets. In principle, assets turnover can be increased by either two methods, by increasing sales while holding assets steady, or by decreasing assets while holding sales steady. Reducing receivables and inventory, for example, not only improves cash flow, as described in Chapter 9, but also improves asset turnover, assuming the company doesn't sit on the extra cash unnecessarily. These terms together make up the first part of the DuPont equation, often labeled the simple DuPont equation in finance texts. So that the simple equation is this right here, which is net profits over sales times sales over assets equals net profits over assets. So the ROS times asset turnover, which is return on sales times asset turnover, equals return on assets. The form of return on assets measures the profit you are able to get from your sales. The second term measures the sales you can generate from your company's total assets. Put them together, you get return on assets. Soho Equipment. Bill and Carolyn Michaels performed these calculations for Soho Equipment and came up with the figures shown on table 11.1. So this is what it looks like. 11.1. So you can take a screenshot there if you want to look at it a little further, or open your book. The analysis helped them to see even more clearly where their problem lay. They could see that the return on sales declined significantly from 2.2% in year 2 to 1.44% in year 3. They could also see that asset turnover declined only a little in the same time period, from 2.65 to 2.59. Their conclusion, though they would benefit somewhat from better asset management, in particular decreasing their receivable days, their most pressing ROA challenge was to improve ROS. Their analysis underscored the importance of what they had learned when they analyzed their company's net profit, namely that they could not afford to let their cost of goods sold or sales ratio increase as it had. The extended DuPont equation. Managers generally care most about the ROA when they're assessing a company's health. It's the most broadly based return figure, and it tells you in one fell swoop how a good job the company's executives are doing at managing sales, expenses, and assets. Company owners and shareholders, by contrast, often care most about another measure of return, namely return on equity, or ROE. It shows how much profit they're making for each dollar of equity they have invested in their company. What's the difference between ROA, return on assets, and ROE, return on equity? For starters, it helps to remember the difference between assets and equity. Assets are valuable resources the company has and uses in their business. So assets are valuable resources the company has and uses in the business. The total assets line on the balance sheets includes cash in the bank, money the company is owed, the net book value of fixed assets such as machines and vehicles, the value of inventory, and various other items. But somebody has a claim on all these assets, and those claims show up on the other side of the balance sheet. Some of the claims are held by creditors, such as vendors, banks, and other lenders, and the government. These are the people the company owes money to, and their claims are summed up in total liability. The total liabilities lined. So the who you owe money to is in the total liabilities line. Other claims are held by the company's owners. They own whatever is left over. The total assets minus the total liabilities. This is their equity. You may remember this as a basic accounting equations. Assets equal liabilities plus equity. Despite the financial terminology, it's a common sense concept that people use every day. If you buy a house for $250,000 and the bank holds a mortgage for $200,000, you know you have $50,000 worth of equity in the house. Similarly, if a company starts up with a $10,000 stock investment and borrows $5,000 to buy a machine, the company now has $15,000 worth of cash and equipment, or $15,000 worth of assets. But it owes $5,000. The bank has a claim on that. So the equity held by the company's owners is still only $10,000. Of course, you can imagine a company that for some reason has no liabilities, no accounts payable, no debts, no liabilities of any kind. In that case, its assets are equal to equity. Nobody other than the owners has a claim of any of the company's assets. The difference between assets and equity, therefore, is OPM, other people's money. If your company has liabilities, as nearly every company in the world does, it is using other people's money to help generate profit. Its assets are greater than its equity. From a standpoint of financial analysis, the important question about a business isn't whether it's using other people's money, since virtually all companies do. The important question is how much of other people's money is it using, and whether it can do so prudently and productively. A company, after all, doesn't want to borrow more money than it can put to work. It doesn't want to borrow more money than it can afford to pay back. Just like individuals, plenty of companies borrow too much and wind up in bankruptcy court for their troubles. Maybe you have heard of the debt to equity ratio, which is simply debt divided by equity. That is a useful measure in that it can show when a company is overextended. This ratio is part of another useful measure, the assets to equity ratio, or total assets divided by equity. An assets to equity ratio of 1.0 means the company has zero liabilities. A ratio of 3.0 means that $3 of